All right, as the group starts to level off in attendance, I want to thank everyone for joining us during this session. Where, regardless of what time zone you're in, I have the pleasure of being here today from Charlotte at DISCRETIONARY's Innovation Forum. There's been a lot of questions about trends in DC innovation this morning, which I hope filters through to today's conversation. And before we kick off the time we have together today, a little bit of a logistics. This webinar is being recorded, so it'll be available for distribution for you to share with any of your colleagues after the session. Also, please participate. You're in listen-only mode, so we would love you to submit questions within the chat box, either right now it's on the right of my screen, but wherever you have it located on your screen, you select chat and submit the question. I'll be facilitating as a moderator today, and I'll be using that as a mechanism to ask questions of our two panelists and subject matter experts, either at the point when they're speaking or near the end where it makes the most sense. But feel free to ask your question as we're going, and we'll make sure to filter it in. With that being said, without any further ado, maybe it's time for us to introduce ourselves. Again, my name is Bill Ryan. I am the head of NEPC's Defined Contribution Practice as our head of DC Solutions. I'm excited to be here with you all. This is one of NEPC's pride projects, our annual trend survey. And it's an exciting topic that we have every year that we look forward to sharing with you all and getting your feedback in the moment as well. And with that, without any further ado, I'll hand it off to Andy and team to introduce themselves.
Thanks, Bill. My name's Andy Papadimitriou. I'm a consultant on the DC team here at NEPC. I led the annual Plan Trends and Fees project last year, and I'm a subject matter expert in managed accounts. And I'll turn it to Allison to introduce herself.
Hi, everyone. Allison Lonstein. I'm a principal and senior consultant here at NEPC on our defined contribution team and work with a number of our large DC plan clients. Excited to be here to share some of the insights from our annual survey and really appreciate you taking the time out of your busy schedules to tune in with us. So I'm just going to spend a quick minute on the agenda. We have about 30 or 35 minutes of prepared remarks, and of course want to save some time for any questions that come up from the audience as well. So just a quick preview in terms of what we have on tap for today. Andy's going to talk a little bit about the process and what goes into this survey, as well as what we're seeing from a participant perspective in terms of number of holdings and average balances. Then we'll get to the meat of the presentation, where we're going to touch on a variety of different topics, including the target date fund and managed account utilization, some conversations we're having with clients regarding the core lineup, as well as how we're incorporating ESG and DEI into the research that we're doing on behalf of our defined contribution clients. Benchmarking of fees and expenses is what I'd call the second element of our annual survey. While it's an incredibly important topic for our clients, we're not going to spend too much time on it today, but we'll talk about some of the trends we're seeing relating to investment fees and record-keeping fee trends. We're also going to touch on some key challenges that we recognize our clients are facing today, whether it's retirement income or trying to unpack the recently passed Secure 2.0. And then lastly, Bill will just touch on some of the trends we're seeing relating to OCIO in the DC market and any potential growth we anticipate in the coming years. So with that, I'll turn it over to Andy.
Great, thanks so much, Allison. If we turn the page, I will spend just a second sort of setting the stage and taking a step back to talk about what the survey is, how it is that we utilize the survey, and sort of how we're even able to conduct the survey. So to start, as you've likely deduced from the title, the survey is a dual purpose survey, with half of the survey relating to trends regarding number of funds in a lineup, types of funds, usage and utilization, plan design features, as well as participant behavior. And the other half of the survey is related to fee benchmarking, both of investment expenses as well as administrative fees, such as record keeping, trust and custody fees. The way in which we're able to conduct the survey is really due to two groups of people. The first, of course, is our defined contribution team here at NEPC, who helps us determine which clients would like to be included in the survey, what data points we need, and sort of helping us get those data points filled in. The other group of people that I need to make sure we extend a huge thank you to are our clients' record keepers, who have been really gracious in partnering with us and dealing with all of our requests and getting us all of the data that's needed to be able to have a survey. So without both those groups of people, we would not be able to actually have a survey. So I want to make sure we take a second and extend a thank you to those groups of people. Jumping in to some of the numbers that will inform the survey, you'll see that over 100 clients are participating in the survey, and that represents more than 200 plans. If you're doing some quick math in your head, you're likely figuring out pretty quickly that our clients tend to have multiple plans within their purview. And with that, a majority of clients included in the survey are corporate clients, but additionally, we have healthcare, public, nonprofit, and Taft-Hartley plans included in the survey as well. The survey spans over $280 billion in assets, which speaks to the sheer volume in terms of the number and types of plans that we're working with. Additionally, I want to spend just a second focusing on the number of participants included in the survey. The survey spans over 2.2 million participants, and one of our core defined contribution beliefs at NEPC is participant focused. So we really think of participants as being the core of all the work that we do, and all of the work that goes into working on defined contribution plans is at the benefit of participants. So really keeping participants in mind as we conduct not only the survey, but our day-to-day activities as investment consultants here as well. The last number I'll touch on this page is the number of record keepers, which you'll see 12 record keepers responded to this survey. And again, we very much so appreciate their partnership there. But if you've tuned into our survey in prior years, you're probably wondering or thinking that that number has gone down over time. And if that's something that sort of jarred your attention, you'd be absolutely right. That's something that we noticed in conducting the survey as well and doing our own reach outs to record keepers. Something that we've noticed and tried to sort of dig a little bit deeper into is why that number has changed over time, because it has decreased. And one thing that we found is that there's been mass consolidation within the record keeping space, and that actually led to our defined contribution team having a legal and regulatory webinar last year around cross-selling and consolidation within the record keeping space. So if that's a topic that's of interest to you, you can head over to our insights page, of course, after this webinar to take a look at that. And now that we've laid sort of the groundwork for what the survey is all about, we can turn the page and jump into some of the statistics that came out of the survey. And we'll start by talking about participant statistics and behavior. Perhaps where all of our attention on this page is being drawn is that 2.5 number. And what that number represents is the average number of funds being held by participants. And I want to reiterate that because that's a really important statistic. What that number means is that despite the number of options available in a given lineup, despite it being as few as 5 or upwards of 15 options, and Allison will talk a little bit about how it is that we think about menu construction, regardless of that number, the average number of funds held is fewer than 3. While that's perhaps a jarring statistic, what that allows us to then do is really focus on what's available in a given lineup for participants. So that number can then help committees and plan sponsors make informed plan design decisions around the number and types of funds available in a lineup. The other element that number lends to is asking the question, if participants are only holding a small subset of options, what are they actually holding? And if you look just below, you'll see that a majority of participants are holding at least one target date fund. And below the dotted line at the bottom of the page, you'll see that a majority of contributions at year end were into the QDIA or the plan's default option, which is most commonly target date funds. And so all of these statistics together lend to two things. One, the first thing being what's available in a lineup is really important, and this allows us to have informed discussion around the number and types of funds available. The other thing that this tells us is that the target date fund available in a lineup, which is oftentimes also the default option, is really important since it's being used by a lot of participants. So this then allows us to have conversations around what the appropriate target date fund or default option, if it is in fact the default, is crucial. So we think periodic monitoring, reviewing, and even the selection and monitoring of the plan's target date funds is crucially important. And Allison will spend some time talking about how we think about target date funds as well. I want to now draw your attention to the gray box to the right-hand side of the page that houses participant data. In years prior, we've typically only looked at this at the overall level, so just the all data relating to average and median balances as well as tenure. One enhancement we've made this year is by asking record keepers to break out participants over 60 or those that we think are at or near retirement. And we're really intentional in doing this. As retirement income discussions continue to be at the forefront of conversations within committee meetings, we think it's important to have a better understanding of participant behavior for those older participants. And some things that we can glean from this quick snapshot is, unsurprisingly, older participants have higher balances than the overall sample. But then what we're able to do with that is be able to sort of get really granular and talk to committees specifically about what might be appropriate for their participant base as far as retirement income goes. And with that, I think it's a really nice segue into the next section that Allison will cover on target date funds and menu construction.
Great, thanks, Andy. So as we highlight here on slide 6, target date funds can continue to be the default option of choice for our clients, with 96% of clients offering target date and the majority utilizing them as the qualified default investment alternative, or QDIA. We highlight that about 46% is the average our clients' plan assets have in target date funds. And while that's up from the prior year, we do view this as a lagging statistic. As Andy pointed out on the prior slide, we're seeing over 60% of new contributions on average going into target date funds. So we do expect the plan assets invested in target date funds will continue to rise over time. And while we're seeing an increase in adoption of passively managed target date funds, we still see about 66% of our clients utilizing some form of active management within their target date fund offering. And I'll just point out that this figure also includes those clients that implement custom target date solutions, which is more common among our larger DC clients with plan assets of about $2 billion or more. So again, as Andy already mentioned, we do view the selection and design of a plan's target date fund as a critical fiduciary decision for our clients, as these options should really be able to support participants in the savings phase as well as in the spending phase as a source of income in retirement. So the chart on the right hand highlights the trend in target date fund allocations are increasing, which is that light blue bar. You can see up from about 28% in 2011 to about 46% of plan assets on average currently, which of course has a direct impact on the core lineup. As you can see with the dark blue line here, the assets invested in the core menu have declined from about 72% in 2011 down to about 54% today, which I think this trend really emphasizes another one of our core defined contribution beliefs, which is all about designing a purposeful plan menu for investment options for participants. So if we move to the next slide, we highlight what we're seeing within the core menu in terms of number and types of options being offered across our clients' DC plans. And when it comes to investment structure, there really is no one size fits all approach. So at NEPC, we understand each plan and their participant demographics are different. So of course, the number and types of options that are offered in each plan varies too. So on this slide here, we show that the floating bar charts in the middle of the page here just demonstrate the number of core options our clients are using across the different investment objectives that are described on the right-hand side of the page. And what you see here is that most of our clients fall into the role of innovation category, where about 60% of you are offering a range of about 11 to 14 core options. And this typically, in addition to offering a variety of active and passively managed choices across US, non-US equity, core and core plus bonds, these plans also include additional options such as global equity, high yield or high income bonds, ESG, or inflation protection options, for example. And so while the majority of you fall into this category, we do have some clients that have moved to an all passive menu. That is somewhat less common, as just about 2% of our client plans are doing that today. But we also know that some of our clients offer 15 or more options, which represent about 21% of plans that we work with. And for those clients that do have a higher number of options in their DC menu today, if the design is not intentional, if you're holding more choice for legacy reasons perhaps, it could be a good time to consider conducting a structure review to just reevaluate the role and purpose of each of the core options offered to your participants. We also acknowledge that many of you have experienced recent turnover, either of the committee and/or staff members. So as new members are going through fiduciary training and education, it could be a catalyst again to just revisit the lineup if you haven't gone through that exercise in the past few years or so. So if we move to the following slide, we dive a little bit deeper into investment plan design. As we think about a DC menu, it's often structured to cater to a wide range of participants in both the savings and spending phases. So on the left-hand side here, we capture what I would call a typical lineup with virtually all plans offering some form of an asset allocation or pre-mix offering. Target date funds, of course, being the most popular, which we highlight are in about 96% of our plans today. And then the right-hand side of this page just highlights the prevalence of the different fund options across all of our DC clients. This is not an exhaustive list, so if you have something in your lineup that's not mentioned here, don't worry. We just focused on the more commonly used options across of our clients that were included in the survey. So I'm going to spend a few minutes on this slide. I'm going to jump around a little bit, so bear with me as there's a few topics I want to touch on, and hopefully addresses some of the questions that you've asked us about. And the first is relating to active and passive managed options in our clients' core lineups. I highlighted on the prior page that the majority of our clients offer a mix of both active and passive choices. And we see about 83% of you offering at least 3 index funds in your lineup, with the majority of plans offering 4 passive options. If you look at the slide here, if you ignore target date for a minute, you can see that US large cap index funds are the most prevalent option across our clients, with about 96% of you offering one today. However, we have started to see some plans simplify their US equity passive option by consolidating the S&P 500 index and the SMID cap index funds into a single all cap equity index fund. So as we continue to see more and more dollars going into target date, for clients looking to streamline the core menu, this could be a fairly straightforward way to do so. We're also starting to see some clients move away from offering active options in certain asset classes. This is most commonly being considered across some of the segments of the US equity market, such as large cap. However, if we look at the data, we still highlight that about 85% of our clients are offering an active large cap equity option for participants. So I think just, again, given the challenges this asset class given what a challenging asset class this has been for active managers, growth in particular over the last couple of years, it could just be a good reminder to revisit the role and purpose of the options in your plan. We've had some clients take a look at cash flow patterns, which has just helped inform committees and staff on the participant usage across the active and passive options in their plan. Also on the theme of streamlining, another conversation we've had with clients has been revisiting the balanced fund offering in their lineup. So currently we have about 28% of plans that offer balanced funds. This is down pretty considerably from about 43% about a year ago. We often think of balanced funds as a legacy option, which in many plans was the default before target date funds came into the picture. So as a result, we often find that the biggest users are older participants, as you know, target date funds are the primary option held by younger folks. And given the static asset allocation for balanced funds, you know, it's typically 60-40, 65-35 equity bond splits. This could lead to unintended consequences for older participants who end up with higher equity allocations in retirement. So we have supported clients in a number of these types of conversations, just really helping them to understand how participants are using options in your plan to determine if some change may be warranted to help improve outcomes for participants. Capital preservation options is another topic I want to touch on. We have seen a rise in plans that are offering stable value. So that rose by about 10% over the last year. And so you can see here in one of the green bars that we have about 76% of plans offering stable value today. We do think that stable value may become front of mind for a number of you folks this year. And there's a few reasons for that. The first, of course, is given the dramatic rise in interest rates we saw last year, this has put some pressure on stable value funds. So you may be getting some questions from participants asking why the yield on money market funds is higher than their stable value option in the 401k today. So just something to be mindful of. In addition, as part of Secure 2.0, as clients start to consider some of the voluntary provisions, there is one relating to pension-linked emergency savings accounts. This will be required to use a cash option, could be money market, could be stable value. But again, as we think about going into 2024, this could be another catalyst to review your capital preservation options. And then lastly, when you pair target date funds with stable value, which is what a lot of our clients are doing today, it does provide a reasonable choice for participants in the context of retirement income when it comes to sort of a non-guaranteed type investment choice. And that really brings me to my last conversation. I told you I had a lot to talk about in this slide, so I hope you're still following along. But the last topic I wanted to touch on is retirement income, which is something that we have been getting asked a lot about. I don't have this particular stat on this page, but it is highlighted in our full report, which is available if you're interested. But one stat I wanted to highlight is that we have found that most plans, so about 84% of you, are already offering a retirement income solution today. And that is really based on the plan offering both a target date fund designed for participants in retirement and the flexibility to take systematic withdrawals as a source of income in retirement. So we also know that plans that allow for flexible distributions tend to see participants remain in their plan longer and into retirement. So as we think about what do we do from here, we are starting to see or getting questions from clients about how to complement what they already offer in their plan today, and really some have started to think about potential guaranteed solutions or lifetime income solutions, which we have displayed here in the light gray boxes on this page. And so one potential entry point, if this is of interest for you and your plan, which may be appropriate, is an out of plan annuity window. Today, we highlight that only about 2% of our clients are utilizing or offering a window today, but it is something that we could explore with you in the future if that's of interest. I mean, I think at the end of the day, the majority of our clients are still kind of kicking the tires on this topic. We do expect that over the next few years or so, we will see an increased interest, perhaps increased use in annuity windows, as we have seen new record keepers introduce new solutions for clients as well. So I think with all that said, retirement income solutions is not entirely clear cut. There's a lot of different paths clients could take, and we do stand ready to help you evaluate what's practical for your plan and most importantly, your participants. So with that, I'm going to turn it back over to Andy, who's going to talk a little bit about managed accounts, which is a topic she spent a lot of time on. And I just wanted to highlight too, as part of our upcoming client conference in May, managed accounts will also be on the agenda. So we hope that you can tune in for that as well.
Thanks, Allison. So moving into a topic that's gotten a lot of airtime and at times scrutiny over the last year, you'll see that managed accounts is offered by about 38% of plans that we work with. And while optically on the page, that looks like a really big number relative to the other numbers perhaps surrounding it, what that really means is that a minority of plans are actually offering managed accounts today. And that's a statistic that's remained stagnant over the last few years. So despite, time and sort of marketing of managed accounts, we're not seeing that number or that prevalence number increase. And with that, I want to talk about some of the participants utilizing managed accounts. And despite there being a number of plans offering managed accounts today, it's actually a much smaller subset of participants that are actually utilizing managed accounts, just 5% of participants utilizing managed accounts, and an even smaller subset of participant assets are invested with managed accounts. And I'm being intentional about my word choice there because we really see managed accounts as a portfolio management service, and we think of them as portfolio management fees when we talk about fees. And as we talk about participants utilizing managed accounts and then managed accounts investing their assets, we want to also talk about managed account users, and we break them down by age. And we do this intentionally because we think of the value or impact of managed accounts being different for participants at different ages or life stages. You'll see that we've broken the participants using managed accounts to those under 40, representing early career participants, all the way up to over 55, which we think as being late career, at or near retirement. And we're intentional about doing this for a few reasons. If we talk about sort of the value or impact of managed accounts, and I'll start with older participants, those over 55, again, at or near retirement, representing a quarter of managed account users, we think of the value or benefit of managed accounts for those participants as benefiting from spending advice. So how do we wind down participant assets in retirement relative to younger employees, those under 40, representing 39% of managed account users? And we think of the benefit or value for younger participants as being solely directed to savings rates. So we've seen with data that managed accounts increase participant savings rates, which is a good thing. But I also want to dig into that a little bit deeper because we think that there's the potential for that to be challenged in the future. You're perhaps familiar with Secure 2.0, which was passed in December of last year. And while we're not going to go through all of those provisions today, there is one that I want to focus on for just a second, and that's a provision related to auto enrollment and auto escalation for new plans. And now that's not something that's going to be effective tomorrow or the next year. It's going to be effective in 2025. But it's something that we think will impact savings rates or the benefit of savings rates within the managed accounts landscape. And what I mean by that is that as new plans get sort of established and then have to offer auto enrollment and auto escalation at these rates dictated by Secure 2.0, after a year, they'll become sort of grandfathered in or lumped in with all plans, and we'll have no indication or way of knowing what's a new versus old plan and where the impact is coming from. So we think going forward at some point within perhaps the next 5 years, the value or impact of managed accounts for those younger participants is really going to be challenged and diminished. And now as we talk about the value of managed accounts, it's also important to have a conversation surrounding fees. So if we move from the left-hand side of the page to the right-hand side of the page, you'll see we've laid out 2 box and whisker charts, and these are charts that you'll see from us again in just a few minutes. We've laid out in these box and whisker charts managed account fees as a percent and in dollar terms. And you can think of these charts as that wide box representing 50% of what we're seeing in sort of the sample data. And then those tails extend to the minimum and the maximum. So you're really seeing the full range of fees, both as a percent and in dollar terms. I'll start with the top chart in dark blue. And what you're seeing is that fees have a wide range and that they range from about 10 or 11 basis points to upwards of 60 basis points. We see with managed accounts that they're typically on sliding fee scales. So the more dollars that are invested through managed accounts, the lower that fee becomes. And there are potentially new entrants that have come to market that will alter what this chart looks like in the future. But as we talk about managed account fees as a percent, it's also really important to dig into what that looks like in participants' dollars, because again, we see this as a portfolio management fee on top of the investment expenses that participants are already paying for whatever is under the hood as far as lineup construction. And so if we look at the fee in dollars, you can see that the range is rather large and that the chart does look a bit skewed. And what this tells us is that what this is showing us rather is the impact of managed account fees and how many dollars participants are allocating. So you'll see that the fees range all the way up to upwards of $2,000. And what we're seeing with this data is that fees overall are becoming more negotiable. So we're seeing some plan sponsors being able to sort of have discussions and on making those fees sort of less standard or what was typically offered and pricing them differently. The other area that we're seeing with this is that some providers are starting to offer hard dollar fee caps, meaning that participants will not be charged above X dollar amount per quarter or per calendar year. So those two items sort of coupled with what we're seeing in the managed accounts landscape as far as new entrants to the market, we think will really influence the future of managed account fees. And at some point in the future, we would anticipate both of these charts really coming down as far as lowering fees. In the same vein of fees, if we page ahead, we'll spend just a few minutes talking about the other half of the survey that's related to investment and administrative fees. You're seeing again these box and whisker charts that we just talked about, but in this instance, we're looking at plans and breaking them into different buckets based on participant counts. So you'll see all the way to the left-hand side, plans with less than 1,000 in that dark blue, and plans get bigger and bigger, ending with a bucket that's over 15,000 participants. I'll start with the top chart, and this is looking at benchmarking investment fees. And of course, we do this exercise on a quarterly basis to look at separately from this page, benchmarking investment fees relative to institutional peer medians. But we also do this particular exercise on an annual basis, and we think it's important because it gives us a sense of what other plans are doing. And so what we're doing is taking the asset weighted expense ratio. I'll caveat that by saying this is highly driven by the types of funds that are available within a lineup and how participants are actually allocating their dollars. For instance, plans that have passively managed target date funds that take up a healthy allocation of plan assets will have a lower asset weighted expense ratio relative to a plan that has actively managed target date funds, which will typically and make up a healthy percentage of plan assets, that will typically drive the asset weighted expense ratio up. So these are subject to change just based on what's available and how participants are allocating. But one element that we've added to this chart this year, and we really think it's an enhancement, and it goes hand in hand with what we talked about with managed accounts, is layering in the impact of managed accounts on the asset weighted expense ratio. We've talked a little bit about how we think of managed accounts as a portfolio management tool. And so what we've done is we've figured out how to add that portfolio management fee on top of the investment management expense already present from the managers within the lineup. So if you were to compare last year's survey to this year's survey, you might notice that all of these boxes and whiskers have gone up. So the maximums have gone up relative to prior years, and that's just because of the impact that managed accounts has on the asset weighted expense ratio. If we move from investment fees to the bottom half of this page and focus on record keeping, trust, and custodial fees, you'll see that we break plans up into these different buckets as far as headcount goes. And while this doesn't tell the full picture in terms of what services are actually being provided, we think it's a nice visual aid to represent where our participant or where our clients' plans stack up relative to peers. For instance, if you had a plan with about 10,000 participants, they'd be in that light blue area, and you'd be able to plot on that page what their per head charge is. Again, it doesn't tell the full story, but it's a great visual representation to showcase where your plan might stack up to peers. We, of course, then take that a step further and look at the services being provided and determining if that's reasonable for the fee. But we think this is a really nice way to sort of leg into that conversation. And with that, we can transition from what might be a more historical topic into a topic that we think is a little bit more forward-looking. So turning the page, we'll talk about ESG and DE&I within the DC landscape. There's a lot on this page, so I think it makes sense to first start out by explaining at a high level what both of these items are. ESG, those letters representing environmental, social, and corporate governance. And when we think about ESG investing, it's how our manager is able to take those categories and implement them into investment ideas. When we talk about DE&I, diversity, equity, inclusion, we're looking at our managers diverse, is there access, opportunity, and support, and is it an inclusive environment with engagement and acceptance across? And with that in mind, it's also important to take a second to highlight how our manager research team thinks about these. So overall, our manager research team utilizes a framework with a rating scale of 1 to 5, 1 being our highest conviction ideas and 5 being our worst. And a 1 rating as far as ESG and DE&I goes in a similar framework where 1 is the highest conviction. A 1 means that the firm or strategy fully integrates ESG and or DE&I into their process. A 2, again, our second highest conviction, means that from an ESG or DE&I perspective, both of those topics have been identified as a material factor in investment decision-making process. So now that we've sort of laid the groundwork for this page, we can then jump into some of the numbers on this page. We'll start with the screening approach, which is one of the two approaches we have listed for ESG. A screening approach at a high level is just looking to screen in certain securities or screen out certain securities for non-financial reasons. And you can see that that represents a very small percentage of plans utilizing. Just 6% of plans are utilizing a dedicated ESG option that screens securities in or out. And we're typically seeing that as being passively managed, so an ESG index, so to speak, which represents just 3 basis points in terms of assets. The other number that I want to talk about and spend a little bit more time on, because it's a much bigger number and perhaps a surprising number, is that 79.2% number. And what that 79.2% number represents is the percentage of plans utilizing managers or strategies with ESG factors built in as part of the investment process. And I want to say that again so it's really clear. These are not dedicated ESG strategies. These are managers and strategies that at some level utilize ESG factors within the investment process. And what this really means as far as the sort of gravity of this number is that ESG is more prevalent than we've previously thought. And then that turns the conversation from just looking specifically for one factor to a much easier conversation about picking good managers. So not specifically focusing on one aspect, but really making sure that managers are well-rounded. And that's sort of a way to leg into the conversation around ESG, which we've been asked about, but is a really challenging conversation given the regulatory environment, which can be really challenging for plan sponsors and committees to be able to talk about. The other factor I want to talk about on this page, flipping from ESG to DE&I, is that we've partnered with our manager research team to determine if there's a percentage of plans with favorable or a 1 or 2 DE&I rating from our manager research team. And what we found is that almost 10% of plans today utilize managers with a favorable DE&I research rating. And that, coupled with the ESG integration number, we think really is going to have sort of forward-looking momentum, so to speak. And that's something that we would expect in the future for both of those numbers to increase over time. Both of these conversations can be really difficult and challenging or overwhelming, but we think starting sort of at the core of, looking just at the managers within your lineup probably makes this an easier discussion to start having if it's of interest to your committees. And with that, I'll turn it over to Allison to talk about some of the questions that we're being asked and what we're thinking about the future.
Great, thank you, Andy. So I know we've thrown a lot of information at you. I hope it's been really helpful. But as we start to wrap up our presentation today, this slide here was intended to summarize some of the more common questions that we're getting from all of you, which have helped to influence the conversation today, as well as some of the potential discussion and action items for clients to consider over the next year. So we mentioned Secure 2.0 a few times already, which I think is very appropriate, just given the significant piece of legislation that's going to be impacting DC plans in the coming years. And for those clients that want to learn more, we do have a webinar on our website available. It's a part 1 of a 2-part series. So the current recording really provides more of a immediate focus and discusses some of the provisions that are in place now or coming soon in 2024 to really help our clients kind of navigate this piece of legislation. Part 2, which will address the longer term considerations, will be available later this month. So definitely check that out if there's interest. Of course, I just want to acknowledge while markets were down pretty significantly last year, I think this could result in a lot of different topics for plan sponsors to consider as we look out into the future. This, of course, could take a different meaning for each of you, depending on where you are in your fiduciary calendar. So perhaps it's just taking a fresh look at the investment structure of your plan, like we talked about earlier. If not, or if you offer custom white label options, have you revisited the structure and managers within those options over the last few years? If not, could be a good time to do that. And we have resources and tools available for you to help support you there as well. And lastly, given the importance of target date funds, conducting a review of your QDIA may be in order as well. And if you need one more thing, this would be a light touch item, but for the roughly 66% of you that offer a brokerage window, if you have not reviewed that offering in the last few years, you could consider doing that as well as a way to reaffirm that you want to continue to offer that. So with that, I'll pause, see if any questions have come in from the audience.
Thank you both. Fabulous job in laying everything out. And I think, Allison, you set expectations. I think we punctually hit the 36-minute mark.
Right.
So we're on point there. So there are a few questions that have come in throughout. This is just, as Allison said, a reminder to circulate more questions through the chat. We have still some time to ask our colleagues here what they're seeing. The first one, as I read it here, Allison, there's a question both that I received earlier today at the Innovation Forum and here's more specifically around custom. There was a question from the audience last year. We spent more time on custom. Is there a change in how we think about it? Are there certain clients that are better fit for it? You know, what's your perspective? And this could be, it seems like can be applied to target date funds or core lineups and however you're seeing it in the marketplace.
Yeah, so that's a great question. Thank you for whoever brought that up. I don't want you to think we're ignoring custom or no longer working with clients on custom. It is a part of our broader survey, so maybe it just didn't make the cut in today's webinar. But we are seeing about 11% of our clients utilize custom options in their lineup. Where it's more common is it with larger clients, where we see about 42% of our clients with over 2 billion and about 47% of plans with 5 billion or more utilizing custom. So we are still supportive on where we think it makes sense. I think when we think about clients that utilize custom, about 42% utilize it for the entire menu, and about 17% utilize white label custom target date fund options. So I think there's a number of reasons why clients consider it. One, I think, is it's because it could be a very strong risk management tool. So as plans grow in size, using a custom multi-managed option can help address manager concentration issues within a portfolio. It also allows clients to introduce either new asset classes or niche strategies within a custom option. So we are continue to be supportive. I don't want you to think that we're not just because we didn't spend too much time on it today. But importantly, we have quite a few new tools in-house that can help you evaluate those types of solutions.
Perfect. Thank you, Allison. Now, Andy, I think this question is directed towards you. I think maybe it's related to managed accounts. And so maybe an underscore, as you talked about managed accounts and then you talked about record keeping fees, what are some of the go-forward strategies or things that you're seeing develop as it relates to how they're structured, how they can be negotiated, things of that line?
Yeah, absolutely. There's definitely been a push by record keepers and managed accounts providers to try to get more participants involved or even offering managed accounts. When we talked about fees, we said that there were areas for plan sponsors to sort of kick the tires. And I think there's sort of a few ways that they can do that. The first is seeing if hard dollar fee caps can be offered. If you determine that managed accounts are something you'd like to keep, but that's an area that you're concerned about, kicking the tires on what is there a stop dollar value that we can sort of get participants not paying above, because as you saw that chart with the box and whisker plot in dollar terms was really skewed. Another area is as I mentioned, new entrants have come to the market, so being aware of what others are charging can perhaps aid in conversations around what your participants are being charged. And then lastly, we're seeing new fee structures. And what I mean by that is that we're seeing some plans being able to negotiate fee structures that are at the overall plan level rather than at the participant level, which is a really unique way to try to price managed accounts. So those are three areas that we think plan sponsors can really start to kick the tires and see what managed account providers are able to offer them.
That's good. I have maybe one more question, and Allison, I think it's directed towards you, and it's tied to the large bold retirement income statement there we have on the left. And the question I think drives back to maybe when you're talking about plan design, you use the term retirement income and lifetime income. So it may seem like maybe a definitional change, maybe they're synonymous. The group, it looks like, is there a simple definition for one versus the other?
So we view lifetime income as a form of retirement income. So retirement is kind of the broader category, where lifetime income, what we mean by that is really where it's typically an insurance based solution where there's a guaranteed income component. So that's the key difference, is that we highlighted that big stat of 84% of our clients offering retirement income. We don't mean that 84% are offering lifetime income. So it's really important to understand the differences between those two terms.
That's perfect. And I oversimplify it. You've heard me say this oftentimes. It's third grade math of rectangle and a square, where lifetime income is a square. It's a special type of rectangle. So we have another question that just came in, and it says, have we seen any trends in how many plan sponsors or record keepers present managed accounts relative to market value? I think maybe the question is,
maybe like it's forward-looking analysis, which is something that we have the capability of doing. I don't know if that's what they're asking.
Why don't you start with that one, and then we can talk about it from, I think, a marketing or commercial aspect, which may be the second way you could interpret the question.
Sure, I'll start and then feel free to jump in. As far as, we talked about in the managed account section that managed account assets are actually a much smaller percent relative to what's actually plans offering. So we think that, as far as pricing, which is maybe where the question was headed, that's one area that we think people could, again, kick the tires. As far as potential market value, my guess is that the person was asking about sort of forward-looking and expectations. And with that, I would say we have our own in-house analysis, as Allison kind of alluded to, and we think this is a tool that we could really utilize to sort of model out forward-looking expectations of managed accounts for your participants. So that's one area where we think we can really help in evaluating managed accounts and the impact that they have on your participants sort of in a future state.
Perfect.
One of the questions we got too is just asking about what we're seeing in the marketplace relating to OCIO. Do you maybe want to take that one?
Yeah, why don't we take that one? And actually, with perfect timing, I think maybe we saved a slide on slide 13 to talk about this. We've spent a fair amount of time couching the conversation about leading and lagging indicators, whether it's target date funds or number of funds held. We think the conversation about OCIO or discretionary versus advisory is similar. We've seen even within NEPC that about 1 out of 10 of our clients, or 10% of our clients, have engaged us to look at a DC OCIO arrangement. We're also seeing from a marketing or a forward-looking perspective, about 25% of the RFP activity that we're seeing, led by third-party evaluators, is asking about OCIO going forward. So if the leading indicator is the RFP and that we're on a learning curve, let's just say half of those RFPs, so 12.5% go OCIO, that's going to be the leading indicator. We'll go from 10, we'll go to 12, we may be on a path to 25% in the next 3 or 4 years. I think that number will creep up. And I think, Allison, you and I got this question yesterday and maybe in tandem to retirement income. But I think if we think about this, it's more related to COVID. Coming out of COVID, there's been a few things that have happened that have been pretty public. There's been the Great Resignation. There's also been a Great Retirement. And so there's institutional knowledge that has left the workforce at a plan sponsor over the last 24 months, that as we get back into the swing of things, different plan sponsors are needing different ways to support their fiduciary needs going forward. And I think that's going to be a catalyst or a tailwind as we see more employers who their core competency isn't managing retirement plans start to look at service providers to help them augment their committees. So with that, appreciate the question. Thank you, Allison, for identifying it there. I know we're about 10 minutes out, and I am starting to see the numbers start to slide a little bit here. So I think I'll respect everyone's day. Thank you for spending part of your day with us today. Please, we know all of you who are attending, so that means all of us. If there's a question you didn't ask, please contact your person at NEPC. we'll be able to either have them answer it directly or put you in contact with one of us to help you solve for your question going forward. So appreciate your time, appreciate your support in helping create this survey. Without all of you, we wouldn't be able to do it. And we hope you enjoy the rest of your day.
Thank you.